Friends, welcome to the channel JIV and CIV Made Simple. Today we are going to discuss our unit number 34 of AFM. Very important chapter based on marginal costing. So it's all about marginal costing which we are going to discuss now. So let's get started and understand the concept of marginal costing. So quick question. Suppose that if I ask you how much it costs to make one more pen, right? What I'm talking about? How much it cost you to make one more pen? Can you answer this? How much it cost you to make one more pen? Could you tell me? Today we will learn a simple idea that answer exactly that. How can we answer it? Today we will learn the idea. Right. Stick with me. This one idea can make management decision a whole lot clearer. Think of a small sweet shop. Right. You can think of a very small sweet shop. Right. Think about it. So basically there are flour, there are sugar, there are labor for each laddu change, right? The number of flour, sugar, labor for each laddu changes with how many laddu you make. These go up and down as you produce more, but the rent of the shop stays the same, right? What do you think about the rent of the shop? Does it change? Rent, you think about the rent. Shop rent remain the same, right? It is same whether you make 10 laddu or 1000 laddu, no matter what. So marginal costing is a method that focus on those costs that change with the production. Okay, so marginal costing focus on those costs, right, that change with the production. There you can see the definition clearly written. Cost of producing one additional unit of product and service, which means the marginal costing is focus on those costs that change with the production, or in short we can call it variable cost. It focused on the variable cost. Marginal production focused on which kind of cost? Variable cost. Please remember it. Right. So variable cost means what? Which changes with production. Fixed cost means what? Which stays the same. So here are some definition which you can see. First definition is the marginal cost. So whenever you see this word marginal costing, what it means? It means the extra cost to produce one more unit. Then you see the term variable cost. So variable cost means what? Variable cost means ingredient, wages per unit, packaging. These are changed to the product. So marginal costing means cost to make one extra unit. Variable cost is changes to product. Fixed cost changes together. Right, changes to period. So why do manager like this method? Because it tells you how cost behave. Right. So here in marginal costing I told you only variable costs are charged to operation. So why this manager like this method? Because it tells you how cost behave, which cost move when you increase or decrease production, right? Which cost move when you increase or decrease production. Should we accept a special low price order? Should we produce one more unit or stop, right? Should we produce one more unit or should we stop? Marginal costing make those decisions clearer because it separates the cost that actually changes from those that do not change, right? These are the points. So friends, that is the marginal cost. Another important idea is marginal contribution. So I hope the concept of marginal cost is clear, because should we produce one more unit or should we stop? This question is answered by the marginal cost. Along with that, there is another key idea which is the marginal contribution. Here you can see. So it is just selling price minus the variable cost. How do you find it? First of all, you write the sell price, you subtract the variable cost of the one unit. This will give you the marginal contribution. Think of it as the money left from each unit that goes toward covering the fixed cost and then the profit. Right. So whatever money is left from each unit, where it goes? It goes toward covering the fixed cost. Right. Whatever money is left, it goes toward covering the fixed cost, plus it goes toward covering the fixed cost plus the profit. Right, plus the profit. Right, that is called marginal contribution. So the bigger the contribution per unit, the fewer unit you need to cover the fixed cost. So this is called contribution. Contribution means how much money goes toward covering the fixed cost as well as the profit. That is called contribution. Now you think about it. The bigger the contribution per unit, the fewer unit you need to cover the fixed cost. Because contribution is more means what? Contribution is more means more money left from each unit that goes toward covering fixed cost and profit. So the bigger the contribution per unit, the fewer unit you need to cover the fixed cost. So remember, marginal contribution formula is very simple. Just write sale price selling price and you subtract the variable cost, this will give you the marginal contribution. Let me give you a quick example to understand it. For example, let's suppose that you sell a product at rupees 100. Suppose selling price is 100 rupees. Okay, selling price is 100 rupees. Now let's suppose that variable cost is 40 rupees. Variable cost is how much? 40 rupees. Fine. Selling price is 100 rupees. Variable cost is 40 rupees. So what will be the marginal contribution? Marginal contribution will be 100 minus 40 is equal to 60. Tell me, is it okay? So that 60 help in paying the rent and the salary, which are the fixed cost. So once fixed costs are covered, the rest become the profit. So to summarize what we have covered in these two slides, let me summarize. I told you that marginal costing help manager by focusing on the extra cost of making one more unit, charging only variable cost to produce, treating the fixed cost as a period expense, and using marginal contribution to guide decision. It is simple, practical, and very useful in day-to-day business choice. Now friends, let's switch our focus to the next slide. So have you ever wondered in tough business time how do company decide the right selling price, or how do the company know which product is actually making money? That is where marginal costing become a real game changer. Let's see how it help in everyday business decision. First of all, it help in fixing the selling price under the tough time. Yes, you can see now, it helps in deciding the sale price under the adverse business environment. Imagine your factory is not doing well, sales are going down. You can think about it just like some example. Suppose your sales are declining, they are decreasing, sales are decreasing, right? And competition is very high, competition is increasing, right? So what will happen in such a case? Marginal costing help you decide the minimum price. It help you decide the minimum. What should be the minimum price? Okay, what should be the minimum price at which you can still sell the product without going into loss? So it can be decided using the marginal costing. Basically, as long as the selling price cover the variable cost, you can survive in the short run. So minimum price means at least cover variable cost. That is the minimum price, right? Now no need for separate record. Second point is that you need not need you do not need any separate record. Means this method of marginal costing uses the same data from the normal accounting. So you don't have to maintain a separate set of book. This save time and this also avoid the confusion. It can help you finding the break-even point. You can see it can help you to determine the break-even point. So break-even point is a magic point where no profit, no loss is there. Marginal costing make calculating this super easy. It shows you how many unit you need to sell to cover your fixed cost, right? Marginal costing shows what? How many unit you need to sell to cover your fixed cost. The number of unit you need to sell to cover your fixed cost is what marginal costing shows you. So remember the formula of break-even. Break-even formula is very, very important. Suppose I want to know what is the break-even point. So just remember, in the numerator you write the fixed cost. In the denominator you write the contribution per unit, C per unit. That would give you the number of units required to break even, right? Fixed cost divided by contribution per unit. When I say contribution per unit, it means what? How much money from the total revenue is going toward covering the fixed cost as well as the the profit. So that is what that is what our contribution tells you. So whenever you want to find the break even point, just divide the fixed cost by the contribution per unit. Second thing, how marginal costing is help. You can see they can help in compare product and departments and regions. Suppose you sell 3 product or have branches in different cities. So marginal costing will tell you clearly which one is pulling its weight and which one is dragging profit down. It's like a report card for product and department, right? So that is the point you can see here written here, that appraise product, territories and segment of the business. Okay, then a strong tool for cost control. So manager can see where costs are rising, especially variable cost, and the take action very quickly. That is why marginal costing is seen as an effective cost control technique, right? Then the next point is show the role of fixed cost in profit. It shows the impact of fixed costs. What is the impact on fixed cost on profit? That is what is shown by the marginal costing. So it highlights how fixed costs like rent, salary, electricity impact the overall profit, right? It reminds manager that even if sales goes up, unless contribution per unit is strong enough to cover the fixed cost, profit won't improve. Right? That is the point. It tells the manager that suppose your sales is going up and up, but your C per unit, contribution per unit, is not strong enough to make enough profit to cover the fixed cost. Then you know, then you know, it profit would not improve. So to improve the profit, your contribution per unit should goes toward what? Should goes toward improving the fixed cost. So the advantage of marginal costing are very clear. You can see it is helping in pricing, right? First of all, I told you na, it is helping in the pricing. It is helping in determining the break-even point. Okay, and then product and department appraisal. You can appraise product, you can appraise department, right? And understanding the fixed cost, you can understand it is an effective technique for cost control. You can understand the impact of fixed cost on profit. Okay, so all these things you can understand using the marginal cost. So friends, till now marginal costing look like a superhero tool, right? But just like every superhero has a weakness, marginal costing also has its limitation. And to understand those better, we will look at the something called CVP analysis, a very handy tool for your JIV examination as well as the real business life. You know, marginal costing says that we must separate cost into fixed and variable. But in real life, you know, this is not always neat, right? For example, electricity bill. Part of it is fixed, which is a basic charge. Part of it changes with the usage. So the split is not always precise, isn't it? So this is one of the limitations, that you know, splitting the cost is not realistic, is not always accurate. Second thing is that assumptions about cost is not realistic. So first point I told you now, segregating cost into this fixed and variable is not always be precise. This is the first limitation. Second limitation is that it assumes that fixed cost will never change and variable cost always move in exact proportion to the production. That is what it assumes. Okay, but that is not true in practice. Salary may increase over the time. Bulk buying may reduce material cost per unit. So cost don't behave in such a perfect way. So this is an assumption that we make before while applying the marginal costing. The first thing is that fixed costs do not vary and the variable costs are 100% proportional to the production volume. But this is wrong. Why it is wrong? Because you know, sometimes salary may increase over the time. Or suppose you can say that you buy in bulk quantity, so material cost per unit will get reduced, isn't it? So this cost does not behave in such a perfect way. This is another second limitation. Third limitation is the inventory valuation. You know, in marginal costing, fixed costs are not included in valuing the stock. Yes, fixed costs are not included. This is a very important point, that you know, we are not including the fixed cost in while valuing the stock. So the value of the finished goods or work in progress shown in the account may look lower than the reality. This can sometimes mislead the management. So inventory valuation become very tricky, right? This is one of the major limitation. Become unrealistic. Why? Because we are not including the fixed cost in while the valuing the stock. So the value of the finished goods or work in progress shown in the account may look lower as compared to the reality. Then you know, the one assumptions about the selling price is too simple, right? Which it assumes that selling price per unit stays the same. You see now, sale price per unit will remain the same, but no matter how much you produce or sell. But in real market, if you produce more, you might have to reduce price to attract buyers. So again, not realistic. So basically, if we summarize, what are the main limitation of this marginal costing? That cost split is not precise. Is that segregating cost into fixed and variable cost is not precise. Second thing is that unrealistic cost behavior, right? And then third thing is that you know, inventory valuation is undervalued. And fourth thing is that price is assumed constant, right? Sale price per unit is, you can see now, sale price per unit will remain the same. This is one assumption. Okay, so these are the four important limitations of the marginal costing. Cost split not precise, unrealistic cost behavior, price assumed constant, inventory get undervalued. Now we have to deal with this situation. Manager often use something called, you know, CVP, cost volume profit analysis. This is like a dashboard. It tells you how cost, sales volume and profit are linked together. First of all, we will classify cost into fixed and variable, right? Two kinds of cost are there, fixed cost and variable cost. So fixed cost stays the same no matter what, like rent or insurance, and variable cost changes with the sale, right? Changes with the sale. So like raw material or sales commission, these are the variable cost. So you can see fixed cost stays the same like rent or insurance. Variable cost, they change based on the sales volume, like material or commission, right? So then we use a simple formula, which is the formula looks like this: profit is equal to sales volume minus cost, which is further broken down like this. So you can write cost like this. Cost has two components, right? Fixed cost and variable cost. So sales volume minus fixed cost plus variable cost. So this is the basic cost volume profit formula, CVP formula. This helps manager quickly see how many units they must sell to cover the cost, and what happen if the sales goes up or what happen if the sales goes down. Means to cover the cost, how many units they need to sell, right? And what will happen if the sales goes up and sales goes down. So let me give you one example to make it more clear. Let's suppose I'm using this here. Okay, so let me give you one example. Let's suppose that fixed cost is 50,000 rupees. Fixed cost is 50,000. Okay, and let's suppose that selling price per unit is how much? Let's suppose it is 200. Let's suppose variable cost per unit, it is how much? It is 100. Okay, now what would be the contribution per unit? C per unit would be how much? See, it is simple, S minus V, which is how much? 200 minus 100, which is equal to 100 rupees per unit. Now suppose I want to find the BEP. BEP, that's called break even point. How do you find that? Simply write 50,000 in the numerator and divide it by the contribution per unit, which is 100. So 50,000 divided by 100 would give us how much? 500. So that means you need to sell at least 500 units to cover the cost. So that is the break even point formula which is written here, right? What is the break even point formula? You can just write down it like this: fixed cost divided by contribution per unit, or you write it selling price minus variable cost, right? This is the formula for the BEP, break even point, right? So while marginal costing is a powerful tool, it has some practical limitations. So we have just seen that marginal costing is a powerful tool, but it has some practical limitation. That is why CVP analysis comes into play. It gives a clear picture of how cost, how volume, how profit move together. And trust me, this is one of the most exam friendly concept for your examination of JIIB, especially AFM topic. Now friends, let's look at the refined formula. So here is a formula that ties everything together: how sales, how cost, how units sold give you the final profit. The formula looks something like this: S into N minus F plus V into N is equal to P. So what is the meaning of this? C, P means profit, S is the sales value per unit, N is the number of units sold, F is the fixed cost, V is the variable cost, right? I hope this is self-explanatory. So let me give you one example to illustrate it. So one example is given in your book. Let me explain using this. Suppose there is a firm that making thermometer. They have fixed cost given how much? You can see this is your fixed cost. 1 lakh is the fixed cost. Okay, like rent, like salaries, this can be fixed cost. Then variable cost of per thermometer they have given 120 rupees per unit. Selling price per thermometer they have given 160 rupees per unit. And unit sold in the year is 3000 thermometer. Now we need to find the profit for the year. That is what we need to find. Okay, so how do we find that? Simple, right? First of all, calculate S into N. Selling price is 160 rupees per unit and total number of units is 3000. So it will be how much? 160 multiplied by 3000, right? It will be 4,80,000. That is our selling price, right? The same thing has been done. So selling price total revenue is 4,80,000. Now let's calculate the variable cost. So variable cost is how much? See, variable cost per unit they have given how much? 120 rupees and 3000 thermometer they have sold. So just multiply 120 with 3000. What you need to do, what I am telling you, to find the total variable cost, just write 120 rupees per unit multiplied by 3000. That would give you 3,60,000. That is our variable cost, right? That is our variable cost. So now we know the variable cost. Now we know the total sale. And total cost will be how much? Total cost will be the fixed cost plus variable cost. Fixed cost they have given 1 lakh. Fixed cost you can see they have given 1 lakh. And VC just now we have calculated. It is how much? 3,60,000. Now can you tell me what will be the total cost? Total cost will be 1 lakh plus 3,60,000. That would be 4,60,000. Isn't it? 4,60,000. Now total cost is 4,60,000 and total sales is how much? 4,80,000. So the profit is 20,000. For that particular year. That is what has been explained here. The final result is 20,000. You can see it here. There is an alternative quick method also. There is one quick method also which you can apply to solve this problem. What you need to do in the quick method, let me explain. You just do one thing. You find the contribution per unit, right? Just write, calculate S minus B. Means selling price per unit minus variable cost per unit, which is how much? 160 minus 120, which is equal to 40, right? And then find the contribution. This is contribution, this is a small c. Find the capital C. Capital C is a small c multiplied by n. Contribution per unit multiplied by number of unit, which is equal to 40 multiplied by what? 3000, which will be how much? 1,20,000. So that give you the contribution, isn't it? Now from that contribution you subtract the fixed cost, because you know it very well that you know it now. If you draw the pie chart, do you know the method of pie chart? Let me explain. If you draw this pie chart, so this portion is the VC, this entire portion is the contribution. It has two parts. One part is the fixed cost, another part is the that is called profit, right? So we are interested to find the profit. So now we have calculated the contribution. From contribution, if you subtract the fixed price, that would give you the profit. So what is the contribution? Contribution is just now we calculated 1,20,000. So 1,20,000 minus 1 lakh, that will give us 20,000, which is the profit. So this is the way. So what does this 20,000 rupees tells us? What does this tells us? It tells us that after covering all the variable cost for the 3000 thermometer and paying the fixed bill for the year, the firm is left with 20,000 as profit. The contribution per unit 40 rupees shows how much is thermometer help to cover the fixed cost. Once fixed costs are covered, that 40 rupees become profit per additional unit sold. See, again I am repeating. What we have got as contribution? We have got rupees 40 rupees at the contribution. Now someone may ask you, how can you interpret this 40 rupees? It shows that how much is thermometer help to cover the fixed cost, right? How much is thermometer help to cover the fixed cost? Once fixed costs are covered, right? Once fixed costs are covered, that 40 rupees become profit per additional unit sold. So friends, remember, right, I hope this concept is crystal clear. The same thing has been explained in these three slides, as you can see. So after all that number crunching, what is the final profit of our thermostat company? I told you it is nothing but 20,000. But here is the bigger question. What if the company just wanted to cover all its costs, no profit, no loss? Suppose the company just wanted to cover all its costs. It neither want profit, neither want loss. So that point is called, break even, right? Break even point. And this is where break even analysis comes into play. So remember, this break even analysis is the part and parcel of the CVP analysis, cost volume profit analysis, right? So basically it shows the relationship between the cost, sales and the profit. Here is the idea. Every unit you sell give you something that you call contribution. Whatever you sell give you contribution. So friends, every unit you sell give you something that is called contribution, right? Contribution, the formula for contribution is selling price minus variable cost, SP minus VC, that is the contribution. This contribution first goes toward covering the fixed expense. So 1 unit of product, whatever you sold, give you something called contribution. Contribution formula is very simple, selling price minus variable cost. This contribution first goes toward covering the fixed cost. Once fixed costs are fully covered, any extra contribution turn into profit, right? That is the point. So contribution is, the formula for contribution is sales price per unit minus variable cost per unit. Back to our thermostat case. So what was the contribution per unit? Like suppose selling price is 160 rupees, variable cost is 120 rupees. So 40 rupees was the contribution per unit. So each thermometer sold contribute 40 rupees toward covering the fixed cost of 1 lakh, right? So each thermometer that we sold, they contribute 40 rupees toward covering the fixed cost of 1 lakh. So after 2500 thermometer, the company break even. Sell more than 2500 and you will start making the profit. That's why to compute the break even point, we divide fixed cost with respect to the contribution. So break even analysis tells us how many units must be sold to cover the cost. It is a super practical tool for manager and for you in the JIB examination. So friends, here is the golden question every business asks. How much do we need to sell to just cover our cost? That point is called break even point. Let's solve an example together. So break even level means what? Whenever you see this word written like break even level, what is the meaning of this break even level? It means all fixed costs are recovered, all fixed costs has been recovered, no profit, no loss. below this level losses, above this level profit. That is one break even level. Think of it like a finishing line. Until you cross it, you are just running to catch up with the expense. Once you cross it, every extra unit sold start adding to the profit, right? So you can think of it like, running an event. Okay, until you cross it, you are just running to catch up with your expense, and after you cross this level, every extra unit sold add to the profit. Like in this case, take this particular case, LED bulb case. Again, another example to make it crystal clear concept. So here the fixed cost they have given 2 lakh rupees, like rent, salary, factory overhead, and the selling price per bulb is given 60 rupees. Variable cost per bulb is given 40 rupees. So the contribution per bulb is 20 rupees. Just subtract both of them. This means for every one bulb sold, 20 rupees goes toward covering the fixed cost. What is the total fixed cost? 2 lakh rupees. So 2 lakh divided by 20 will give you that 10,000, right? So you need to sell the 10,000 bulb, after which you will start making the profit, right? So total fixed cost is 2 lakh. To recover this using 20 rupees per bulb, so the company must sell 10,000 bulb to break even. So that is the one way to do that. Just think about it, just to apply the formula. The formula for break even point is very simple. Write fixed cost in the numerator, and in the denominator you write the contribution per unit. This will give you the number break even point, right? So in unit it is 10,000 bulb. Suppose I want to tell in the sales value. In the sales value it is how much? Suppose I want to sell in the sales value, it is 10,000 multiplied by what? You can see 60 is the selling price, right? So 10,000 multiplied by 60, which is equal to 6 lakh. In terms of sales value, 6 lakh is the selling price. So the company needs 6 lakh worth of sale to break even, isn't it? Sometimes we need to express this break even in terms of percentage capacity utilization, right? So you can see in sales volume, this is the answer, 6 lakh. In percentage capacity, sometimes we need to express in percentage capacity utilization. In terms of unit, it is 10,000. In sales volume, it is 60 multiplied by 10,000. 60 is the selling price of each bulb, multiplied by 10,000 is equal to 6 lakh. In terms of percentage capacity utilization, how do you find it? Sometimes question may be asked that what is the break even point in terms of percentage capacity utilization? How do you go about finding it? Very simple. If the plant capacity is suppose 20,000 bulb per year, right? 20,000 bulb per year. So break even point is how much? 10,000 divided by 20,000 multiplied by 100. That would give us 50%. That is the 50% is the plant capacity. So unit 10,000, sales volume 6 lakh, capacity 50%. So whenever you will ask capacity, they will provide you the data that how much the plant can manufacture per year. I hope it is clear. So that is break even analysis in action. It can be shown in units, in money terms, or as capacity utilization. Now we will look at how break even analysis is used in the real decision making. So yes, application of the break even and cost volume profit. So friends, let's talk about the application of break even or CVP analysis. First, think like a banker. When a company comes to a bank for a term loan, right? So it has a very important application in appraising the term loan. Whenever a company come to a bank for a term loan, the bank will obviously check, can this company even cover its cost? Can the company even cover its cost? That means can it operate above the break even point and still make enough surplus to repay the loan? If the company is just touching the break even, then repayment become risky, isn't it? Repayment become very risky. As a banker, you will whenever a company approach you for giving a loan, you will think about it. Can a company cover its cost? Once it cover its cost, then only it can make profit and will repay the loan, isn't it? If the company is just touching the break even, repayment become very risky. That is why bank prefer project with a low break even point. Yes, you will always prefer project, right, with a low BEP, right? Because then the company has a higher margin of safety. Then the margin of safety is higher, right? To survive the shock like fall in sale or rise in the cost. From the company side, break-even analysis tells management what is the minimum level of activity below which we cannot afford to operate, isn't it? From the company side, it helps the management to decide what is the minimum level of activity below which the company cannot afford to operate. It's like a warning signal. Don't go below this level or you will be in loss. That is what break-even point tells to the company. It also helps in designing the incentive scheme. You can see, designing the incentive scheme. For example, if worker or the sale team are given bonuses on extra production, on extra sale, management can clearly see how much extra production will actually increase the profit and how much can be shared as incentive. That's why it helps in the incentives work like an incentive scheme also. Suppose the worker or the sales team, they are given bonus on extra production or extra sale. So management can clearly see that how much extra production will actually increase profit and how much can be shared at incentive. Okay. Another big use is that it helps in comparing the profitability of different products. Yes, that's called, relative profitability of different products. Which means, that suppose a company make bulb or fan and tube lights, bulb, fan and tube lights. So break-even analysis will show which product is more profitable, which one is riskier. And finally, it also guide decision like whether to produce in-house or outsource a company, right? Some decision is guided like, whether to outsource the production or to produce in-house. For example, if producing a part in-house pushes cost too high, increases the break-even point, outsourcing might be the smarter choice. So break-even analysis is not just theory, it's a powerful tool for banker, manager and the decision maker. So now let's talk about its significance. So this profit volume ratio analysis, it is a concept. Friends, let's now talk about a very important concept in marginal costing, that is called P/V ratio. Don't get scared by the name. It's actually very simple. This ratio tells us how much of the sale price is actually contributing to profit after covering the variable cost. Think of it like this. So let me explain using one example. It will be crystal clear to you. Suppose that you sell a pen for 10 rupees. Right, you sell a pen for 10 rupees. Out of this 10 rupees, after paying for ink, so you pay for ink, you pay for plastic, right, and you pay for other cost. So you are left with a contribution of how much? Just rupees 4. That rupees 4 is what goes toward covering the fixed cost and the profit, isn't it? So you pay 10 rupees you have made. Out of this 10 rupees you have made for ink, you have made for payment for plastic, and then you are left with 4 rupees only. That is called contribution. That 4 is what goes toward covering the fixed cost as well as the profit. Is it clear? So friends, what is the formula for PV ratio? Very simple. Contribution divided by sales price per unit multiplied by 100. Means how much of the sale price is actually contributing to the profit after covering the variable cost. Like in 10 rupees, only 4 rupees was going toward the covering the fixed cost. Similarly, in the numerator, what we write? In the numerator, we write contribution per unit divided by sale price per unit multiplied by 100. Okay. So in our pen example, what would that be? 4 divided by 10 multiplied by 100. 10 was the actual selling price and which we bought the pen, and out of that we pay for ink, we pay for the plastic, and only 4 rupees is left to be toward fixed cost as well as the profit, right? That means for every 100 rupees sale that you make, rupees 40 is available as contribution to cover the fixed cost and the profit, isn't it? Now why is this ratio so important for management and for us in the examination? Because for a company which is selling multiple products, it helps in knowing which product is making more profitable. That is, it helps in determining you can see written here clearly, it helps in determining the profitability of each product. This is one of the, suppose a company is producing multiple products. So they want to know which product is more profitable. So using this P/V ratio, they can determine it. Second thing, management can decide whether to push the sale of a certain product or to reprice it. Yes. So they can decide which product to push sale or reprice. And third, it can help in decision like should we buy a component from outside or keep production in-house. Yes. So should we outsource or should be in-house? So remember, higher the P/V ratio, the more profitable the product is, isn't it? Suppose I give you 3 products. Suppose you have a company and you are producing 3 products and they have the different P/V ratio. So which one is more profitable? Obviously the one having the higher P/V ratio, because in the formula of P/V, in the numerator, what we write? Contribution per unit. In the denominator, we write sales price per unit. Now let's see this particular slide. Very, very important and very interesting also. For now friends, every business run with a dream to make profit, but reality is full of uncertainties, competition increasing, raw material supply can break, or like we saw recently, even pandemic can also hit. In such a situation, it is not always easy to achieve the sale or production level that we planned in the budget. That is where two important concept comes into picture. The first one is the break even point. Second is the margin of safety. So break even point simply tell us, that is what has been written here, right? These are the uncertainties that business face, right? So the break even level, break even point, which tells us that the minimum level of sales, minimum level of production, which is needed to avoid the loss. If the company is operating below break even level, it is in loss. If it is above break even level, it is in profit. But just reaching break even is not enough. We need a cushion. We need cushion for what? We need cushion for safety. Yes, cushion is needed. For what, Cushion is needed for safety, right? So that is what, that cushion is called margin of safety. This particular cushion we are talking about, this is called the margin of safety. Margin of safety shows how much extra sale we are making over the break even sale. So one is called break even sale, and over and above the break even sale, how much extra sale we are making. Think of it like the safety belt in a car. If a sale suddenly dropped due to market disruption, this margin helped the company still survive without going into loss. Just like a safety belt in a car. Suppose due to external slowdown or due to any reason, the market drop, right? In that case, this margin of safety helped the company still survive without going into loss. What is the formula? The formula is very simple. Estimated sale minus break even sale divided by estimated sale into 100. So bigger the margin of safety, the stronger and safer the business is during a certain time. Remember, for your JIV examination, break even is the minimum survival point. That's why we are subtracting from break even, right? And margin of safety means extra cushion for the bad time, isn't it? Now friends, let's look at the next slide. So friends, we just discussed how the margin of safety work like a cushion for a business during the tough time. Now let's move on to another very important concept, so-called absorption costing. In absorption costing, what happened, right? It is a method of costing where both variable, all the cost absorb into the product. All costs are absorbed into the product cost. That means both variable cost like raw material, packaging, electricity, and fixed cost like rent of factory, manager salary, all are included in the cost of product. That's why it is called, absorption costing. Remember, we are talking about absorption costing. What happened here, as the name suggests, everything is absorbed. All the costs are absorbed into the product cost, right? Very, very important. Let me highlight it, right? Both the variable and fixed costs are included in the product cost. Okay. What are the variable costs like raw material, packaging, electricity, and fixed costs like rent of a factory? All are included in the cost of product. On the other hand, in the marginal costing, what happened, only variable cost was charged to the product. Fixed costs are treated separately, not included in the product cost. That's the difference. In absorption costing, we are including both variable cost as well as the fixed cost into the product cost. While in the case of marginal costing, we were only including the variable cost into the product cost. We were not including the fixed cost. Now you may wonder, why do we need two methods? Absorption costing is mainly used for external financial reporting. You can see written here. It is mainly used for external financial reporting and income tax reporting, right? These are the two segments where absorption costing work very well because it gives a complete picture of all the costs related to a product. Yes, it provides you the complete picture of these are the costs which are related to a product, right? But marginal costing is very handy for internal decision making. So whenever you want external financial reporting, income tax reporting, absorption costing work well because it provides you the complete picture of all the cost. But marginal costing is very useful for internal decision by the management. For example, deciding the selling price, whether to continue or stop a product line, whether to make a component in-house or to buy it from outside. So there, marginal costing is helping. So remember, absorption costing is for showing outsider like investor and tax authority, while marginal costing is more for internal strategy and decision making. Now you can appreciate that why both costing methods are quite reliable and helpful. Now one example is given before you to understand. So let's make this crystal clear with an example. Suppose there is a company that make LED bulb, right? They have some fixed overhead cost that has been given 1,50,000 is the fixed overhead cost. Fine. Now every bulb they produce require direct cost like material, like labor, like utilities. It costs 40 rupees per unit. On the top of that, they also have variable overhead cost of 60,000 rupees. Let me show you. So these are the crucial data. 1,50,000 is the fixed overhead cost. 40 rupees per unit is the cost of all direct input per bulb, right? Per bulb it costs how much? 40 rupees, right? Then variable overhead cost they have given 60,000. Here you can see. Then and in 1 year the company produced 15,000 bulb per year. Okay, now let's see how the costing work. So from marginal costing, what we take, we only take the variable cost. So what is the variable cost? So as you can see, material, labor, utilities, these things are 40 rupees per bulb, right? How much it is? 40 rupees per bulb. Now, so let's first of all talk about the marginal costing. Okay, so now 40 rupees per bulb. What is the variable overhead? So variable overhead they have given how much? 4 rupees per bulb. So you can easily see now, we want to know variable overhead. So 60,000 is the total variable cost, variable overhead cost, divided by the number of unit, 15,000, which is equal to 4 unit per head, isn't it? 4 unit per bulb. That is the variable overhead. So total variable cost per bulb is how much? See, total variable cost per bulb is 40 rupees, right? Plus 4 rupees, which is how much? 44 rupees. This is the variable cost per bulb. Here we do not include the fixed cost, which is 1,50,000. Right, in the product cost, because we are talking about the marginal costing. But if we look from absorption costing point of view, the fixed costs are also spread across all the unit produced. So per unit cost automatically become higher than the marginal costing, isn't it? Since fixed costs are also taken into consideration. So suppose I ask you, out of the marginal costing and absorption costing, where per unit cost is higher? So obviously the answer would be absorption costing, right? So the key takeaway for your examination is that marginal costing only variable cost per unit, absorption costing variable plus fixed cost per unit. Now let's look at this slide. So let's continue with the same LED bulb example and see how absorption costing changes the thing. Remember, under marginal costing, the cost per bulb was rupees 44 because we only counted the variable cost, isn't it? We have only taken into consideration the variable cost, that comes out to be 44 rupees per bulb, and that was the cost per bulb. But in absorption costing, we also add the fixed overhead. How? By spreading the total fixed cost of 1,50,000 across all the 15,000 bulbs. Think about it. Total fixed cost is how much? Total fixed cost is 1,50,000. And how many bulbs are produced? 15,000. So what would be the fixed cost per bulb? 10 rupees. Just divide both of them. And so total cost per bulb as per the absorption costing will be 44 plus 10, which is equal to 54. See the difference. That extra 10 rupees is what make absorption costing always higher than the marginal costing. That 10 rupees. 10 rupees accounts for what? The fixed cost rupees per bulb. Now let's talk about the stock valuation. Yes, let's talk about the stock valuation. Under absorption costing, since fixed costs are also included, the value of the finished goods in the stock look higher as compared to the marginal costing. But here is the catch. If company has no change in inventory during the year, means all the bulb produced are sold, then there will be no difference in the stock valuation, whether we use the marginal costing or we use absorption. So this is a special case. What is the special case? If there is no change in the inventory of the finished goods, if finished goods remain the same throughout the year, then both will give the same result. So remember, for your examination, absorption cost include fixed plus variable, so higher unit cost and higher stock valuation, while marginal costing, and if there is no change in the stock, if the stock remain unchanged, both methods shows the same result. Now friends, let's understand how inventory affect profit under absorption and marginal costing. When inventory increases during a period, think about it. Very, very important aspect we are going to discuss now. Right. See what I'm talking about, Suppose our inventory increases. Okay. Inventory increases during a period means that some of the goods produced are not sold and remain as a stock. So the profit shown under the absorption costing will be higher. Why? Think about it. If inventory increases, which means some of the stock we have not sold yet. So the profit under absorption costing will be higher because in the absorption costing, a part of the fixed cost is transferred into the value of the finished goods stock. The part of the fixed cost is transferred into the value of the finished goods stock. So less fixed cost hit the profit and loss account this year and profit looks bigger. Yes, that is the point. In the absorption costing, what happened, the part of the fixed cost, that is the kind of inventories obviously. Okay, the part of the fixed cost is transferred to the value of the finished goods stock. That is why less fixed cost hit the profit and loss this year and profit looks bigger. And when inventory decreases, what happens? Meaning you are selling more than you are producing. right? Then absorption costing will show less profit. That's because the fixed cost sitting in the last year stock now get released into the current year cost, making profit fall. And if the company sell everything it produced in the same year, then there is no difference in the profit between the marginal costing or absorption costing, because there is no change in inventory. So the golden rule is that if inventory increases, absorption costing will show higher profit. If inventory decreases, absorption costing show low profit. If there is no change in the stock, no difference at all. I hope this is clear. Now friends, let's talk about the difference between the absorption costing and marginal costing. Let's quickly wrap this up by clearly seeing the difference between the marginal and absorption. First point, in marginal costing we do not allocate fixed overhead to the product, but in absorption costing fixed overhead are distributed across all the unit. I hope this is quite clear. We have explained using an example of LED. Second point, marginal costing is built around the cost volume profit relationship, meaning it helps management take decision about pricing, production level and break even. Absorption costing do not use CVP. It has nothing to do with CVP. Right. Next point. Marginal costing, we always classify cost as fixed and variable, but in absorption costing, such classification is not compulsory. Fourth point, stock valuation. Since absorption costing include fixed cost in the product cost, the value of the finished goods inventory is always higher. Obviously, because see simply, we are valuing a stock, we are including the fixed cost also. That's why the costing will look inflated. Right, value of the finished goods will look inflated as compared to the marginal costing. So remember, the key takeaway is that marginal costing is for internal decision making tool. It excludes the fixed cost, while absorption costing is external reporting tool. It includes fixed cost, hence higher stock valuation. And that is all we need to learn from this particular chapter. Very interesting chapter. Everything is, clearly visible. If you understand the word using example, everything is visible. I hope this from this chapter, if any question is asked, you will surely answer. Now I request you to practice more and more MCQs and case studies, which I have provided in the MCQs PDF based on them. Thank you.